This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Eyal Lifschitz of Peregrine Ventures. Eyal, thank you for joining us.
Thank you all. Thank you for having me. It's a pleasure to be here today.
So what was your background before investing in early stage companies? What did you do before this?
So for many years, I was an entrepreneur myself. I started in the early 90s. As a student, I had a little business, and then I met those two engineers, and then we started to work together on a little pump. And my father and some other people from the industry told me, why don't you make a medical device out of it, a pump, an IV pump? And then the medical sector was still absolutely new to me. I mean, my father was there in the pharmaceutical business for many years. So we went and we made IV, a very small IV pump. And in 94, we got FDA approval. After getting FDA approval, we were one of the first companies in Israel to get FDA approval. We went to take it public on NASDAQ, and during the roadshow, we were acquired by Land Pharmaceuticals. And then I stayed with them for some time, and then after 2.5 years left, started another company, which we sold later, and another one, and another one. And after the fifth company in 2001, we started Peregrine in ventures, in which we continued and like to invest as early as possible. We invest in all stages of life science companies, but we like to invest as early as we can. And we continue to create companies and grow them.
Well, that's great. So what excites you right now?
So we do life science investments, and there's a lot going on here in Israel in pharma, in medical software, but mainly in devices, in medical devices. That's the biggest part of the Israeli sector, while our colleagues in the States and also some in Europe invest a lot in pharma. The majority of our investments are in medical devices. And being here in Israel, this really became one of our biggest industries here. There's almost no medical technology which came out to the market in the last 25, 30 years. From CTs, MRIs, balloons, stents, implants in the spine, in the eye, in the brain. We'll talk about cardiovascular a lot today. All of these technologies that came out, they're coming out by the J&Js, the Medtronics, the Toshibas, but almost all of them are either completely Israeli or have very big Israeli components in it. So this is really what we focus. And within the medical device space, we focus, the vast majority of our portfolio is in therapeutic single product use devices, what in the States call the SPUDs. So the therapeutic single product use devices can be either implants or catheter-based procedures, in which we take a procedure in which there's a cut, which is big, and it can be like an open heart surgery, which we try to do the same procedure percutaneously by having as small cut as possible and going through the arteries if possible. Also, minimal invasive procedures in which we take procedures which are being done in the spine, which there's a cut of 1 inch, and we make the same procedure with an improved technology, the same procedure from a 2 millimeter incision only. And this goes on and on. It goes and covers 3 trends. The first trend is to have the procedure cheaper, to have it less expensive. And this became strong with Obamacare, but was already before that, in which we try to keep the patients for a short time as possible in the hospital. We want to bring him out. It's healthier for the patients, and it costs much less. So if we have a technology in which we can do a procedure which a patient should have been in the hospital for 5, 7, or 10 days, and we can release them the next day. For example, a good example here are the valve procedures in the heart. It started with percutaneous aortic valve replacement. The aortic valve is the valve that goes out from the left ventricle into the aorta. And this was the first valve which was percutaneously treated instead of open heart. There are two companies that till today lead the market. That's Medtronic and Edwards Lifesciences. Both companies, technologies here in Israel. And the same is in spine and the same is everywhere. So the trend is we make a much smaller cut and have the patient getting back on his feet much faster in every procedure. Again, cardiovascular, but it's in the spine, in the knee, in the eyes, in the brain. So that's the main area which we like to invest in, which first, the procedure is at the end much cheaper. The patient gets back to his life much faster, and the total procedure becomes much safer. So those three trends is something which we look in all of our investments. And having a heavily invasive procedure done less invasive, that's really what also the strategic players look for. And they buy a lot of our technology. So in medical devices, we have some IPOs, but the main exit route is to sell companies to the big players, to the J&Js, the Medtronics, the Boston Scientific, the Edwardses, most of them American companies, but also some Europeans and some from the Far East. And by doing that, we do three things. First, it's a great investment. It's we make, and this is what we have for. At the end of the day, we manage money which we have to give a good return. Two, it created here an industry, a big industry, selling technology. Export of technology is Israel's biggest export. People have in mind from the late 70s, 80s, and beginning of 90s that when our main export was exporting oranges, but exporting oranges is exporting water, which we really don't have. So since the 90s, and it became stronger during the last 20 years, our main export by far is technology. And the third and most important and most satisfying part of my work really is to bring technologies which improve not only the health of the patients, but also the quality of life. Because one of the things which we neglected in the last 25 years, we worked a lot to make us live longer. And today we really live longer. My children, they will all be over 90. This is going to be the average. But we didn't do enough to improve also their quality of life. They will live 90 years, but what we also have to make sure that the quality of life will be good. So that's really satisfying, and I love what I do, and I enjoy it a lot.
Great. So you work in the medical device sector for investors who are wanting to work in that space. What do you advise them to do before they invest money?
So as a venture capital, we manage money. A lot of institutional investors, insurance companies, banks, these are the majority of our investors, but also we manage money for family offices and also for some high-net individuals who want to invest in technology. And what I advise to those individuals who invest in our funds is three. First of all, make sure that you invest a reasonable amount. It's according to the free wealth for investment. It's still private equity, and it's risky, and it should be not too much a percentage of the savings of these individuals. In general, it should be not more than around 10-15%. That should be total in private equity. Within private equity, in venture, it should be half of that, of those 10, 15%, or maybe even less. So it should be 5, 7%. That's one thing. The other thing is, if people invest in venture capitals, then there are, like in every business, the good years and the years which are not as good. We call them, like in wine, it's in venture capitals, we call them vintage years. There are funds who start just in a crisis, like a crisis which we are going into now. And the next 2, 3, 4 years of investments after a crisis in private equity and venture capital are always the best years. If you look on returns of funds in the States, in Israel, everywhere, if you look on the returns, then the funds which started in 2001, 2002, 2003, after the crisis of 2001, did amazingly well. The average was higher than the funds that started later. Same about funds who started in 2008, 9, and 10, which were extremely tough years. But those funds did extremely well. So it depends very much when the fund started, but also other cycles. There are cycles in which it's easier to take companies public. There are cycles of the big companies in which they compete more aggressively against each other and they tend to buy technology for higher prices. It's very difficult to predict which years are going to be the good years. So if someone wants to invest in venture capital, it's important that he will, again, divide the money which he wants to invest in venture capital and spread it each year so that he will catch the waves of private equity or venture capital, which will be the good vintage years. And it's impossible to know in advance which years are going to be the good ones. So it's important, one, to divide the amount which you want to invest between the net assets which you're about to invest. Only a small part of that should go into venture capital. And the money which goes into venture capitals, again, should be divided so that you can participate in the funds that you choose in every vintage year. And the third thing is invest in funds which invest in areas which are of interest to you. If you're very much into cyber, then invest in funds which are in cyber. If you're in clean tech, invest in funds which are in clean tech. You also want to enjoy the portfolio companies. You want to be involved maybe sometimes as an advisor, as a friend, or just enjoy reading the reports. And if you like life science, then invest in medical and life science funds. Like we have a lot of doctors, we have and ex-managers in the biggest life science companies in the world who invested in our fund. And this is because it's of interest, the area is of interest for them. And also sometimes they're very helpful in the advisory boards of the companies. And also during the due diligence process, they contribute a lot.
Well, let's talk about the state of investing in medical devices. How is the industry evolving and what changes do you see coming up?
Okay. So what we see since 2008, something big changed in the industry in 2008. Until 2008, companies, technologies were bought very early, sometimes just after a few human trials, which is quite early stage for a medical device company. Companies were bought on high valuations. What happened in 2008 was that after the big shock of the crash of 2008, the big companies, the Medtronics, the Boston Scientifics, the Abbotts of the world, cut down a lot of their internal R&D programs. And in some cases, they closed the R&D programs completely down in order to improve the bottom line. What happened then was that 2009, nothing happened. 2010, nothing happened. In 2011, 2012, all these big companies saw that, hey, what's going on? We don't have anything new. We have to buy, again, aggressively. And then again, they went and they bought aggressively new technologies, but something changed. Before that, they had a strong internal R&D. Now they did not. So they tended not to buy companies in R&D stages because they're lost, in many cases, the ability really to continue with an early stage company which they bought, to continue the R&D, bring it to manufacturing and to regulatory approval. So what happened was that in 2011, 2012, when they started to look for companies, they started to look for companies which are more advanced, not as young, already with tens and sometimes hundreds of patients, much closer to regulatory approval or even after regulatory approval. What happened with this were three things. First, we as venture capitalists and investors in the industry now had to continue and carry those companies for a much longer period and during a much more expensive period. When a company goes into final regulatory approvals, big trials, those trials are expensive. So now as an industry, we had to continue and invest in those companies a lot more money than before and for a much longer time. A lot of venture capitals all over the world couldn't fit to this new model. It just didn't work for them anymore. And a lot of venture capitals stopped. Some of them had closed shop. Some of them went to other things. A lot of them stopped investing. Those who continued are those really who are experts in the space and had the ability, also the financial ability, to continue and carry those companies for much longer. The other thing which happened was that now the exits became much bigger. For example, we sold a company here to a company which does percutaneous mitral valve repair, a company called Valtech. We sold it to Edwards for close to $1 billion, a company with zero sales and long before FDA approval. So the exits became bigger. And the third thing really which happened was that what we have now are less investors than were before 2008. Till today, there are less investors. In a way, maybe less competition for the companies, for the funds that have expertise in the space than there was before. So these are important changes really that started in 2008, and we see this impact and those changes very clearly till today.
Great. Can you describe your investment thesis? What exactly and what your criteria is when you look at startups for your fund? Which do you choose and which do you not?
Okay. So there was a survey done by Cambridge a few years ago, 3 years ago, where the majority of the early stage medical technologies come from. What was shown there was that close to 80% started with an idea of a doctor who said, I would like to have this. And it's either his invention or he went together with some engineers. They came to this invention. The engineer took the ideas from the doctor and he put it on a piece of paper on a computer and something came out. And most companies really started that way, that the doctor said, it would be great. I could use for many of my patients, I could use something so and so. We know from our experience that this is, if you go that route, your chances to succeed, unfortunately, are very small. Doctors are a very important part of the process of developing a medical technology. But if you want to start a company or if you want to invest in a medical technology, of course you have to ask a doctor if this is something which makes sense. But you have to make sure from day one, doesn't matter at what stage you invest, it can be very early. Most of our investments are even before the first patents are written. So what we do is we write the first patents. And after we write the patents, we go and we check with the big players in the space, with the Medtronics, with the J&Js, with the Boston Scientifics, with the Toshibas, the Siemenses. We check with them if this is something which, if we would finish the R&D of that, if this is something which they would want to buy, which they would want to sell. And only if they say yes, and also the doctors say that it makes sense, only then we invest. Because at the end of the day, and there's so many cases, and I can give so many examples of technologies which look amazing. But if there will not be a market which is big enough, if there won't be clear reimbursement, if it will not fit into a basket of a sales team, then you won't be able to bring it to the market. So the first and most important thing is to make sure before you invest in a new technology that the big players in that space are interested. And also after you start, you raise the first money or you invest the first money in the company, continue. Make sure that the company that you invest in will be in constant contact with the strategic players in the space and update them. You don't have to surprise them with a product which is ready after 5, 6, 7 years. There's no reason to do that. Update them 2, 3, 4 times a year, where you are, what you're doing, what animal trials you plan, what your results were, what should be the protocol for your first in man, the results of the first in man. When you discuss with them your strategies for the FDA trials, for reimbursement, discuss it with them. Sometimes during those discussions, as they will see that the company goes along and does well, generally speaking, they will give you maybe an offer to buy. But more important, you will invest and you will create a company which really fits the needs of the market. That's the most important tip which I like to give to investors and also to entrepreneurs. Make sure that the strategics are interested in what you're doing.
Very good. So can you talk about a startup that you have funded that is a good example of your investment thesis?
So, yes. So the company that I just told you before, the company called Valti, for example, one of our biggest exits is we met with the big players in the space and they told us, we discussed the aortic valves and then we said, hey, maybe the mitral valve, which is between the left atrium and the left ventricle, could also be fixed percutaneously. And then during this meeting with business development and the R&D guys of this company, we said, no, the market now is so small because this mitral valve, and there are not a lot of procedures that are being done today with an open heart surgery. So why really bother doing it percutaneously? But then when we digged into the numbers and into the data, we understood that fixing the mitral valve could have a huge market. But then, 8, 9 years ago, the market was so small because the procedure, an open heart procedure, was just too dangerous for those patients. And therefore, it was not conducted, but in very rare cases. But together with the strategic, we understood that if it could be done percutaneously, the market could be huge, 20 times as big as the aortic valve market. After we understood that, we made sure we checked with a second strategic because we don't want to develop something only for one strategic. It's not that they invest in the company or anything. We checked with the second one that we're on the right direction. And only then we started the company. This is the Valtech and the percutaneous mitral valve repair. Another company, which I can give you an example, is a company called Memic. Memic is a company which will compete with the only player in robotic surgery really today. There's really only one player who controls almost 100% of the market. It's a company called Intuitive, and they have a beautiful, beautiful robot called Da Vinci, which does laparoscopic procedures. And we discussed for a long time with all the other players in the space, all the other medical players in the space, what would be a better robot? And then 3 things came up. One, the Da Vinci is extremely expensive, costs almost $1 million to manufacture. One is price. 2 is it's huge. It takes up the whole operating room. So let's have something smaller. 3, the arms of the Da Vinci are very accurate, but they're straight. If the arms could be articulated, we could come in from one small incision, we could insert into the body not 1 arm, but 4 arms, and do the whole procedure much safer, much better. So it took us time until we found the right technologies for that. But this is how we started a company called Memic, which will be now entering the American market now within the next year. So, and I could go on and bring a lot of examples of beautiful companies that we helped starting, and with an amazing team of entrepreneurs and managers and doctors, we brought to an exit. But it's the story at the end is very similar. It's find a need, strong IP, continue and develop it, continue and be in constant contact with the big players that you go into the right direction.
It sounds like a great process that's working well for you. In the last few minutes that we have here, what else should we cover that we haven't?
I think there is an area which I'd like to speak about, space which we see that grows very interestingly, and we believe it will grow a lot within the next few years. It's from one side, we see a lot of artificial intelligence being used in procedures, in planning procedures, in diagnostics, in real-time diagnostics, in treating according to those real-time inputs. There we see a lot of data. We see an excellent planning, an accurate planning of procedures. The doctor will have in real time. He will know exactly where the edges of the cancer are in the procedure that he does, and will know it in real time. From the other side, we see a lot of catheter-based procedures which become more and more accurate, smaller, less and less invasive. Catheter-based procedures, robots, which is also a sort of a catheter, those technologies improve all the time. And what we will see in the next few years are those two, the medical AI, the whole planning, real-time diagnostics, and treatment planning, which is software-based, we'll see this converging with the minimal invasive catheter procedures. And out of that, we will get a whole procedure, which is not only the planning, not only the full organ understanding before we make the procedure and during the procedure, but we will have with this together, we will have robotic catheters that at the beginning, they will be operated within the operating room like Da Vinci do. But later on, it can be also from far away. It can be still with a doctor in the room operating it, but getting advice from outside and getting advice from this AI and all of this knowledge, which will be available during the procedure. So the combination between the AI and the automated surgery is something which we will see more and more. We'll see it in brain operations. We'll see it in cardiac interventions. We will see it in spine surgery. And we'll continue and see this more and more. And this is something that this conversion between the AI software and the robotics is something which we will see a lot happening within the next decade or two.
Sounds like a great, brave new future there. I'm looking forward to it. So how best for listeners to get back in touch with you?
Please feel free to contact me. Best is really by email or LinkedIn. My email is Eyal, EYAL, at Peregrine VC, PEREGRINEVC.com. Feel free to approach me with everything. It can be something if you think about starting a company, of how to finance it, or how to build a good advisory board, how to approach a strategic. Feel free to contact me with every question that you will have. My team and I will be very glad to help.
Great. Well, I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you very much, all. Thank you for having me. And absolutely, it was great. And I look forward to get to help as many entrepreneurs as possible. It's a pleasure. Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.